Intermediate term government bonds are the ballast of investments. They almost never lose money, at least when held for 3 years or more. But if you invested in them starting in 2019 expecting a positive return, you were in for a very unpleasant surprise. This is a chart of the value after 3 years of a $1 initial investment in intermediate term government bonds. The x-axis is the start date of the investment. So for example, the first point on the left is the value in 1930 of a $1 investment made in June of 1927. The end value was around $1.13. Except for 4 tiny losses around 1954, everything seemed fine until 2019. At that point, the 3-year returns start to plummet. Let's see what happened. First, let's look at the interest rates on the 10-year intermediate term government bonds. Now let's look at the price of the Dimensional Fund Advisors Intermediate Term Government Bond Fund. Note that this is only the price of the fund. The fund also pays interest, which increases the value of the investment, and those interest effects are not shown. We can see that they're mirror images. When interest rates go up, the price of the bond fund goes down and vice versa. Starting in 2020, interest rates began a steep rise, which caused a reflective drop in the price of the fund. But interest rates have risen in the past without causing losses. Why is this time different? For example, rates rose between 2003 and 2006, but our previous slides showed no losses during this period despite the drop in prices. It's easy to see why. Part of the reason is the steepness of the rise in the rates, and the other reason is the starting interest rate. The dividends in 2003 started around 3.5 to 4%. So when we look at the returns, including interest dividends, we see that the interest dividends more than offset the gradual loss in value. In 2020, however, the interest rates were close to zero. They were nowhere close to being sufficient to offset the very steep loss in prices. So starting from a very low interest rate followed by a rapid increase in rates caused the large losses.
So now what? Interest rates are now higher than they were in 2020, which will help boost future bond returns and protect bonds from losses. Furthermore, the Federal Reserve has started reducing rates, which could provide a boost in returns from the prices going up, although there's no guarantee of what rates will do in the future. For example, as of September 23rd, 2024, the Dimensional Intermediate Term Government Bond Fund has had a total return of 5.3% over the preceding 6 months. Annualized, that's almost 11% per year. That would be a very nice return for bonds if this pace continues. Therefore, we think it would be unwise to give up on bonds. However, there are some adjustments we're making in our planning. Our previous investment recommendations were optimized based on returns through 2021. In 2024, we re-optimized based on returns through 2023. Looking at an example benchmark retirement plan, which generates a level inflation-adjusted income for 30 years with a 15% risk of shortfall each year, one can see that the portion of intermediate term bonds has been reduced while the small cap value and the US Treasury funds have been increased. Also, the anticipated real income has been reduced 2.8%. So if our benchmark previously projected an income of $100,000 per year from investments, we now project about $97,200. In summary, bonds have had a rough patch since 2019 due to Federal Reserve policies, but they're in a much better position now. The lesson is don't give up on bonds, but you may want to adjust your positions and expectations.